Right then, my investing friends, it's been too long. It's been a horrific year. Let's have a look over the portfolio, see how we're doing. And I wanted to just start with this chart. This is a chart from Y Charts, and it shows the percent drop from all-time highs of a number of big growth companies over the course of the last few months as we've seen the drop in the stock market. So I hold 9 of these positions, and looking down it, I'm sure you guys hold a number of them as well, unless you're more sensible than me and you've only been holding ETFs and index funds. Look down this list. Right at the top, we've got two of the biggest companies in the entire world, Google and Microsoft, down 23 and 24% respectively. That is a massive drop. It's a quarter of the business has been taken away within the last few months. This list is not full of speculative growth businesses that we were all having a punt on. This is full of some of the biggest businesses in the world. JP Morgan, Nike, Tesla is down 37% from all-time highs. Amazon down 39% from all-time highs. Disney has been cut in half. As soon as you get to the point where we're 50% down nearly, it's going to take 100% for that business to get back to where it was. 100% growth for it to return to where it was. It's been cut in half. And then when we get right to the bottom, look at these bad boys. Peloton, Virgin Galactic, one of my holdings, of course, is down nearly 90%. So in order for this to return to where it was before, this needs to be a 10-bagger. It needs to be a 10-bagger to get back to where it was before. Is that likely to happen anytime soon? Who knows? So I just wanted to use this as an illustration that if you're holding a couple of speculative positions that are down quite a bit, you're not on your own. This is not an isolated incident. The stock market has taken a pasting over the course of this year. Perhaps it's a bit of a wake-up call. Most of us will have never seen drops like this within our portfolio unless you've been investing for a very, very long time. But these are the times that are going to dictate how well you're going to do in the long term with your investment portfolio. It's not during the biggest bull run of the last century. It is at these times when we're in a market crash, when we've got inflation through the roof, when we've got a cost of living crisis, and effectively when we're entering into a recession. These are the times that are going to dictate how profitable you are going to be in the long term. So in this video, I'm just going to go over my portfolios. I hold one with Hargreaves Lansdown, I hold one with Trading 212, and I'm going to explain exactly what I'm doing during some of the most testing times in most of our investing careers. Starting then with Hargreaves Lansdown. So this is a portfolio that I hold, and the first thing that might jump out to you if you've ever seen my portfolios before is that we can see that there's 2 positions for Aviva. So what is going on there? Well, Aviva are going to be giving a load of cash back to their shareholders, and as a part of that, there's going to be a little bit of technical process going on in the background, but it is another example of Aviva actually being one of the best stock picks I ever made. It is returning fantastic dividends. It has grown by 30-40%. It is held during a recession, during a cost of living crisis, during all of the things that we mentioned before, and it is continuing to do well and paying back its shareholders. It is the most boring business in my portfolio probably, but it is definitely one of the best performing. Beyond that, looking at some of the indexes that I hold, they've all held pretty okay. You know, we've seen some decline. The decline is nothing compared to the growth stocks. The one that's probably doing worst at the moment is the Japan Equity Index. That's been doing bad for about 3 decades now, so not much expectation there. My purpose for having that, as I've mentioned before, is diversification. I've got the whole world covered. Now, the big dropper is Shopify. Wasn't in that list I showed before, but it is 57% down on my investment. This is the stock since its inception. So as you can see, where we're at now is $390. We haven't been down at that level since December 2019. So you've had to buy before December 2019 in order to be up within this stock. It has absolutely crashed. Its high was in at $1,700. It is now down at $390. Still up 238% all time, but you change any other metric pretty much, and it's not going to look so pretty. 65% down in a year, 68% down year to date, 78% down in 6 months, etc., etc., etc. Oh, look, over the course of the last 5 days, it's up 13% nearly. So that's the one metric, is it? No, nothing available for 1 day. So that's a one metric where it shows it's gone up. And when I invested into this business as part of my Hargreaves Lansdown portfolio, I did invest into it to hold it for the long term. I did invest into it to hold it for decades, not years. So what have I done? Well, nothing. Look at the portfolio. The only change in here is the percentage returns. The only other change is the fact that I'm being given a load of cash via Aviva. I've done nothing to this portfolio. Tesla, I was up 200%. Now I'm only up 100%. Only up 100%. We'll take that. Do you know what I mean? Over the total portfolio, I'm up nearly 22%. So I invested 9,000. I'm up nearly a couple of grand. I'm up 21%. But that's because I invested into ETFs and index funds. That's because I started investing in 2019, not in 2021, not in 2022. Zoom out. It always comes back to that. Zoom out. Look at your portfolio and zoom out. Yes, I was up 40% this time last year, but I'm still up 21% during recession, during a market crash. In my Hargreaves Lansdown portfolio, I am still up 21%. Now, it's important to be fully aware, actually, at this point, that you need to accept, if you're going to be picking stocks, that they're not all going to make you a fortune, and some of them are going to fail. Some of the positions I hold, it could be Shopify, is going to fail. It is going to drop to nothing. It is not going to exist within 20 years' time. Some of these businesses will not exist in 20 years' time, and you need to be prepared to accept that. We don't all go and do stock picking, pick 20 stocks, and all of them are Microsofts. Not all going to be Amazons. It doesn't work that way. No one can do that. No one has ever done that. So it comes back to psychology. You have to be prepared that some of these businesses are going to fail. And where that's most likely going to happen, where those businesses are going to exist within my portfolio, is definitely going to be within my trading 2 and 2 portfolio. So I maxed out my ISA last year, but I'm down 7%. I'm down 1,300 quid. I haven't put anything, incidentally, I haven't put anything in. This happened to me this time last year, so it's happened again. HMRC have screwed me over again, so I'm down 2.5 grand. They sent me a 2.5 grand bill a few weeks ago, so I haven't been able to invest anything yet this financial year. So hopefully next month we can start investing again. That's the issue with not having a massive emergency fund, I suppose. I've taken the one that I was going to invest this month, and I've paid off my HMRC bill. But looking down here, you can see all of my holdings, and there is a lot of red. A lot of big red, minus 21% within Amazon. Even within some of the ETFs and index funds, I'm down. The ones that are holding strongest, as we can look here, when we look at the pies, are the dividend businesses. So my dividend portfolio is still up. Dividend is king in 2022. Everything else is down. Funds are down 4.5%. Obviously, my growth businesses are down 32%. And my new car fund is down 13%. So as we continue to look down the list, the businesses that are hit hardest are the ones that were most overvalued probably over the last couple of years. Look at Netflix, we've looked at it before, and PayPal. I am down quite a lot in them. Thankfully, I haven't got much invested into them. So where I've gone big in my investments, I've done it into safer sort of businesses or into, look at my ETFs. That's where I've gone bigger. So when I've gone into some of these growth businesses, I've not invested as much. And that has saved me in this instance. Look at this dividend business. Pepsi, it's up 25%. 25% increase in a dividend business in the last couple of years. It shows where the market's at the moment. Realty income looking great. Rolls-Royce, another one that has continued to drop and drop and drop, despite pretty good numbers, despite pretty good sentiment. It has been a victim of the market. Tesla, I've got it duplicated in here because I want to drip into it. I want to continue to drip into it where I can't really do that in Hargreaves Lansdown. Uber, massively down, 63% down. Again, thank God, I've not got much invested into it. This is probably one of my worst dividend companies, Unilever. I'm down 6% on that. But I'm going to get a dividend for it. I'm going to get, actually, the amount that I'm down back in a dividend this year. More indexes and some more ETFs that I hold here and then. Virgin Galactic, which I've done quite a bit of content on, has been cut in half for me. Thankfully, I didn't buy anywhere near the top, given that it is a 90% dropper. 90% dropper means obviously it's going to need to be a 10-backer. Just announced it's pushing back some commercial flights as well, so it hasn't helped the picture. And it had earnings report out last month, which was even worse than expected too. So what am I going to do with that one? Nothing. What am I going to do with all of these? Nothing. I'm not going to do anything with any of these holdings. I'm going to wait until I get paid next month, and I'm going to drip into all of them again. And what it probably has done has made me realize I need to increase my percentage allocation into funds over some of these speculative businesses. I think there's no question about that. This has been a real tester for us. But if you've ever watched any of my portfolios before, you'll notice there's nothing missing here. I haven't done anything. I haven't sold anything. I haven't panicked. It hasn't been fun. It hasn't been easy. When I've been logging onto my accounts every day and looking at these, I haven't enjoyed what I've seen, but I'm not investing for the next year. I'm investing for 20 years' time. And I know that some of these are going to disappear and some of these are going to drop to zero. Virgin Galactic could very well disappear in the next few years. Don't think Rolls-Royce could. PayPal could. Netflix could, Some new innovation could come in that changes the way that we consume our media, and that could mean Netflix disappears. I don't think Microsoft or McDonald's or legal in general could. But there are businesses that I hold that could disappear. We need to be aware of that. So what I really want to do with this portfolio is give you a quick tour of the holdings. You might be out there terrified of what's happening within your portfolio, and it is pretty scary at the moment. But it comes down to the fact that if you did your research up front, if you're happy with the holdings that you have, if you're diversified, if you put the majority of your cash into ETFs and indexes, you're probably going to be okay. Not financial advice, of course, but you probably are going to be okay, as long as you're aware that you are going to lose some of those businesses that you're investing into. Now, as I mentioned, my dividend businesses are performing better than everything in my portfolio, even funds. And if you want to check out some dividend businesses I think could be pretty good in 2022, have a look at this video here.